Welcome to the module on capital flows. In the context of international trade, the concept of capital mobility is always highly pronounced. This goes back to the concept of trade when the traders need to borrow the goods and services and thereby they needs to be financed. And for financing the concept of trade, we need the mode of international finance or a better credit always act as a catalyst to spark up the trade momentum. This goes back to the dynamics of international finance, for example, in terms of domestic financial firms which will operate across the country. Also, it will explore a wide range of financial products that are necessary to stimulate the trade momentum. Thirdly, the foreign capital markets need to be accessed properly. And fourthly, there are certain administrative and regulatory procedures which are necessary for any financial institutions to operate. So actually, in the context of the journey from trade to capital mobility, we basically deal with the innovation which come under the financial innovations, and along with it we have the concept of deregulation, because deregulation and financial innovation both will constitute the concept of finance, and that will stimulate the concept of trade. This goes back to the conditions or to the discussions on trends in the capital flows. Whenever we consider the flow of the capital, first we refer to 1990s, the decade of equity finance. This is basically referred to the reforms which were undertaken across the globe in terms of openness to foreign capital, and thereby the financial institutions are basically escalating their entire potentials across the globe. And that is what they are saying, equity capital has been transmitted across the globe. Secondly, we have the increased level of integration. This refers to the globalization concept, which means integrating the country to the rest of the world in terms of dissemination of information or exchange of goods and services in this regard. Further, when we say the concept of integration, we basically want to propagate international bank lending, which has risen to the industrial countries. Mainly the advanced countries of the world have been more welcoming the concept of international bank lending, which has been one of the fallout of increased level of integration. Then we have the concept of government bonds, which are raised by the foreigners and thereby increasing share of government bonds held by the foreigners. That means here we find out the host country government also participates in the bond and the debentures raised by the international moneylenders or international financial players. Moreover, we have the orientation of foreign private sector issuers of bonds and securities to international markets. This is very much important because the capital market across the globe is changing dynamically, and this also involves the participation of the foreign private sector. Moreover, we have the mobile investment funds, which are basically displayed in various kind of forums. So this refers to proliferation of different types of mobile investment funds which are basically having the demat account, and they can be transacted across any part of the globe. So this basically refers to some of the exposure to demand and supply factors which are also responsible for increasing capital mobility. So whenever we talk about capital mobility, we refer to demand for the funds and supply of the funds and how they equilibrate each other. This basically boils down to the first question regarding the framework of trade. So explain the framework of trade. So in discussing the framework of trade, we particularly emphasize on international finance, which is basically acting as a catalytic agent to stimulate international trade. Secondly, some kind of display of portfolio in terms of mobile investment funds are required across the globe. And moreover, the demand and supply factors are also responsible in stimulating this trade momentum. This boils down to a very diagrammatic framework of how the capital is basically being taxed in a capital mobile world. Here we observe that the rate of interest is plotted on the y-axis and capital stock is plotted on the x-axis, and we are assuming that the endowment of the capital is fixed, which is independent of the rate of interest. But the demand for the capital is downward sloping because this is basically the demand for investment. Here the rate of interest is basically referring as the cost of borrowing. So as the cost of borrowing is on the rise, the demand for investment will be on the fall, and that is what is shown across the decay curve. So we observe that the point T and R, so at the point R we observe the equilibrium takes place in this capital stock market where the demand for capital, which is decay, is intersecting with the supply of capital, that is SK. Moreover, when we consider to the world rate of return, because this is basically referring to the domestic rate of return, and here we go for the world rate of return. So we observe that in the world market, also we assume endowment of the supply of capital is vertical and is fixed at K1, and the demand for capital is basically downward sloping, as because it is related inversely to the cost of borrowing. Now the initial equilibrium is at the point D, where we find out the intersection takes place, but the world rate of return is basically lower. That means in the world interest rate market, the rate of interest is lower, which makes the international borrowing to be more cheaper. So that means when we deal with international trade, we basically deal with two levels of interest rate. One is the domestic interest rate, another one is the world interest rate. So if the world interest rate is relatively lower than the domestic interest rate, as we observe in this case where R is lower than T, then it is obviously being said that the international borrowing becomes cheaper, and thereby the domestic country will try to invest abroad because of the lower cost of borrowing. This basically boils down to the question on discuss the model framework. So in the discussing the model framework, we observe capital mobility is one of the main factor, because that is the motivation of the entire purpose, which is a fallout of international trade. Then we have the concept of world interest rate, which should be compared with the domestic interest rate, and that will motivate either international borrowing or international lending. And then we have the rise in the capital stock over time based on accumulation of capital in the home country or at abroad. Now we boil down to the discussion on the positive effects of these capital flows. Because in terms of the extensions we discuss some of the merits and demerits of a country, how it can experience if it opens to foreign capital. One of the positive fold is definitely in the development of the countries. This development calls for a holistic development, not only finance but also in terms of social goods like education, health, and mainly the employment opportunities for a wider range, more innovation, sophistication are dealing with the development of the countries. Secondly, we have the spillover effect of the macro management. This basically refers to ensuring macro stability. With capital flows, we have the flow of foreign exchange reserves. Also, it can also be able to cover the trade deficit, because most of the developing countries are experiencing trade deficit over a longer period of time, where the import exceed the exports. So whenever capital flows comes in, it is inevitable that this will lead to a better macro management policy in terms of better acquisition of skills, expertise, and moreover filling in the deficit in the balance of payment. Then we have the concept of portfolio diversification. This is because the capital flows also can act as a risk developer or risk spreading through portfolio diversification, and capital mobility can be used to lower down the risk. Because when the portfolio gets diversified, it is getting more exposed to the international markets. Then we have the adverse effects. Because every globalization move has both merits and demerits, so the adverse effects basically lead to international capital flows are very volatile. So it is said that foreign direct investment is stable, but other forms of investments, other forms of finance are always very volatile, whether it is institutional or it's private. Secondly, we have the capital flows can cause unsustainable inflationary pressure, because this will lead to increase in the credit accumulation, and this may add on the increase in the price, so inflationary pressures will be on the rise. Then we have it can lead to short-term alignment of the exchange rate, because exchange rates also are very much sensitive to the volatility in the capital flows, because any kind of volatility in exchange rate also will cause either depreciation or appreciation of the currency, and that will also affect the foreign capital flows or the foreign exchange. So as a matter of fact, we can see that the country's tax base may be weakened because in most of the cases, the foreign investors enjoy some fiscal incentives, mainly the tax concessions. So most of the times, tax concessions are enjoyed by the domestic government or enjoyed by the foreign investors, which are let down by the domestic government, and thereby the fiscal balance of the country may be affected. That is what the adverse effects are linked up with the capital flows. So this boils down to the question on discuss the impact of capital flows. So there are many positive effects and many adverse effects as discussed in the last slide, but among them, one of the positive effects is definitely in the holistic development of an economy. That would be the motivation of attracting capital flows. And in terms of the adverse effects, one of the risk factor is this, that capital flows are highly unstable and volatile. They are sensitive to the fluctuations in exchange rate and also sensitive to any kind of global shocks in the nation or across the abroad. Now we open up for the question regarding the motivation of FDI. That means any discussion on capital flows definitely brings us the question that why there is a kind of a tendency to invest abroad. So what can be the dynamics, what can be the motivation behind investing abroad? The first one refers to ownership advantages. For example, in terms of intangible asset, the asset which is basically being flown in terms of the services, where the FDI can come in either in the medical services or in the tourism services. These are the areas when intangible assets are called for. Secondly, economies of size. That means a domestic country or the domestic affiliate might want to explore more expanding in the globe. So thereby they will operate according to the size, according to expansion in their franchisee and scale of business. There are some locational advantages, which means that labor costs and other inputs. This is what happened in Indian economy in terms of IT revolution from the United States. Because India has a large pool of English-speaking, low-cost labor, which were taken up by the US economies in order to excel in the IT revolution, particularly in the automation, outsourcing and call center jobs, which has come up with the locational advantage of lower labor cost. Secondly, availability of skilled labor. Most of the economies across the world are having some specialized skills or unique skills which these MNCs can exploit or can take advantage of because of a comparative cost advantage. Thirdly, market size, growth of the market. So when we talk about the market size or the growth of the market, it basically refers to the expansion in the size of business, where the demand parameters also play an important role. Because the more generation comes in, if the younger population is on the rise, they will demand more sophisticated and more stylized and customized products, particularly in the telecommunication sector, and thereby the growth of the market will excel. Then we have the government, because in most of the cases, government is highly proactive and highly provide incentives to attract the foreign investors, making them a very smooth level playing field. And then we have other costs related to the port, infrastructure, labor and other equipment cost, working capital. All these are involved in the motivation of investing abroad. Apart from that, there are certain internalization advantages. Internalization advantages means that in case of the failure in the markets for final goods and inputs, that means in the domestic country, the intermediate inputs are not being sold properly, so they want to explore some destination where they can sell the intermediate inputs, like the blue chip in terms of development of the hardware or any software company. Similarly, monopoly power, because it may as if assume that the monopoly power is enjoyed by the MNCs, so such kind of advantage can be taken up even at the global forum. So we can now say that along with the product differentiation, that is the brand, that also is one of the internalization factor. Brand means wherever you have the product variety in terms of texture, colors and features. So the question arises that why do invest abroad? So the motivation to invest abroad is driven by three important points. One is ownership advantage, one is locational advantage, and finally internalization advantage. So among them, internalization advantage is about where the company in the domestic front is exercise a broader control in the market, or it has diversified products in terms of product differentiation. This boils down to the discussion of the effects of foreign investment. So when we talk about the effects of foreign investment, the first issue that comes is the concept of multinationals generate externalities. The multinationals are basically the capitalist classes which exercise their firms or affiliate all over the globe in different modes. Either it can be a direct company, or it can be a partnership model, or it can be through kind of public-private ownerships. So in all these cases, externalities are created, which means it adds benefit to the society, not directly but also indirectly, mainly in terms of livelihood generation, mainly in terms of skill formation and more resources for the future. This also refers to the job creation, which is one of the most important motivation to come up in a country which has labor surplus, because there the bargaining power will be very less or no bargaining power, so they can enjoy the comparative cost advantage. Then we have foreign investment generating tax revenues. This is related to any kind of tax which is being imposed on any output or product or production of these multinationals. Then we have foreign exchange, which is basically how the external sector will benefit from any kind of capital inflows, because this is also defining the macroeconomic stability of a nation for a sustainable future. Apart from this, to maximize spillovers, how the government of a country will develop. Because it's not that the foreign capital comes in and all the benefits are being there and the country will automatically reap the benefits. It's not. The host country also developed certain foundations, certain positivities, so that these benefits can be reaped or benefits can be enjoyed. One of them is an integrated policy approach. This is basically about a policy focus where all the nations must come together for a domestic policy which looks after infrastructure, looks after finance, looks after governance, and even looks after human capital. That is when an integrated policy approach comes in. Targeted incentives, like particularly for special economic zones which are export oriented, some kind of extra provisions to be provided. For example, infrastructure benefits or tax concessions. Aftercare policies. This is because an evaluation has to be done after MNC comes in, or after 1 year a kind of auditing, accountability, governance issues comes in, which comes under aftercare policies. Support for indigenous industry. This is actually very important because whenever FDI comes in, there is a kind of a threat or euphoria comes across the nation that the domestic counterparts or industries will be washed away by the forces of globalization. It's not that. Foreign investment should be supplementing the indigenous industry or the industries which are grown within the country. Hence, we boil down to the concept of FDI. So what is foreign direct investment? It is defined as an investment involving a long-term relationship and reflecting a lasting interest and control in an economy. That means it has the objective of a long-term association with the host country government. It is stable. It has high sunk costs, so exit is difficult, and at the same time it wants to set up a parent enterprise in the country with the foreign direct investor. It generally takes the form of acquiring a stake in an existing enterprise. That means either it is there collaborating with the existing enterprise, or it begins from the scratch, which comes under greenfield investment. FDI implies that the investor exerts a significant degree on the management of the enterprise in the economy, because that is how the managerial autonomy is given and how they can cooperate together. Another category of capital inflows, which is foreign portfolio investment, which is basically unstable, and it's referring as a hot money which is pouring into the system, because it deals with stocks, bonds, and commodity market. So this type of investment doesn't have any kind of intention of building a long-term association or an affiliate with the country. That's why it is not direct. It is called portfolio. This is very much short-term in nature, and it takes care of the short-term capital gains, either because of advantages by the exchange rate or any other profits in the process. So any kind of short-term capital gains are enjoyed due to FPI. Moreover, it provides the investor an opportunity to diversify the portfolio and manage the risk. This is also important how the risk management can be done. So we can come up with the fundamental differences between the two, that is FDI and FPI. So in terms of the motive, we can say FDI is basically for the productive capacity, so that the productive resources can be built on for longer association. FPI is only profit motive. In case of FDI, the entire management control is there, autonomy is there. No such thing is there in FPI. FDI is more physical, FPI is highly financial. Duration is long term in case of FDI. As always, FPI is very much short term. FDI is highly stable, but FPI is highly unstable. Impact on growth, FDI is always considered to be a driver for economic growth, which takes care of all the factors. But FPI is only just the short-term success, so it gives a short-term boom to financial markets. In case of FDI, the exit is very difficult, so it is a high sunk cost or non-recoverable cost. But FPI, the exit is very easy. That's why it is highly volatile and unsafe. So we can come up with the question on differences between FDI and FPI. So the differences can be done from stability, from long-term association, and also from the short-term dynamics. So if we go for the classification of the FDI, we can have inward and outward. Inward is when inward FDI takes place, foreign capital is invested in the local resources. That means we are attracting capital. Outward when the local capital, that is the local capital of the country, is invested in the foreign resources, called for outward FDI. Secondly, we can go for some targets like different modes, like greenfield investment, which is absolutely new, starting from the scratch, which as a long-term association. This is mainly done in agricultural sector. Acquisitions is basically coming when two or more existing ventures come up and they can set up a hostile or friendly. Brownfield investment is a combination of greenfield and merger and acquisitions, because that is how both of them can work on. Fresh capital can also come on in the context of brownfield investment, which can be done after acquisition. So we can see that by the nature of business activity, also we can align FDI, like horizontal if they do in the same industry, vertical if they go for upstream and downstream, mainly in the automobile industry, or any kind of conglomerate, like investment in unrelated industry. That means a telecommunication investing in case of automobile, or our FMCG industry investing in textile. So this kind of bending, this kind of collaboration or partnership can come under conglomerate FDI. So it can be also done by the motive, as we can see, resource seeking, market seeking, and efficiency seeking. So when I talk about resource seeking, mainly the OPEC countries which have rich oil resources, so FDI will be attracted to them because those countries are naturally endowed. Market seeking, basically when there is a local production and when exporting is there, larger overseas market can be tapped. In case of India, we go for market seeking FDI because India is a huge market for low cost labor, so thereby the benefits of MNCs come in. Efficiency seeking for competitive and cost-effective global networks, which can be done in terms of algorithms, which can be done in terms of sophistication in Indian business or artificial intelligence models or any kind of computing technologies. So we can see the order of classification, either it can be target, nature, or motive. So now if we can just sum up the benefits of FDI, then definitely resource transfer, which basically brings in more resource and technology transfer. Then we have the employment effects because of job creation and opportunities. Balance of payment effects to cover up the current account deficit or the trade deficit. Competition and growth will be always escalating because of foreign capital. Government also will enjoy revenue out of that. And moreover, FDI is highly stable and less volatile. But there are also some costs. For example, adverse effect on competition, because the competition may lead to monopoly creation. Balance of payment may become more volatile. And also the nation's sovereignty and autonomy may be relaxed because MNCs might have some kind of power or dominating role. And moreover, capital intensive technology can be adopted. So the benefits and the things are being done in terms of BOP, employment, and also skill acquisition, which is human capital acquisition. So we can now say the series of the benefits that we can see to host country, which can come up in terms of government, home countries in terms of overall development, and to all the countries in general across the globe. So in terms of this module, we can see the concept of FDI is well defined among the capital flows, where there is a journey from trade to capital mobility. FDI versus FPI is being compared in terms of different motives. Different natures of FDI are discussed, and also the benefits of FDI are widespread, which can develop a nation, and thereby the nation can accelerate. So this brings in the discussions of capital flows with the objective of long-term association and widespread growth.